Well, we're back and we're going to talk a little bit more on this series here, how to plan for ultra high net worth families. But I don't think this is just for ultra high net worth. I think there's lots of value that can be gained for a lot about what we're going to talk about today. And ultimately, I'm sure everybody listening is on that path to wanting to at least have this ultra high net worth problem, if you want to call it that. More money, more problems sometimes, but also more opportunities. And so, what we thought we'd dig into today, we're going to take the next few episodes to actually dig into some of the high level strategies, if you want to call them that, but subsections of how we actually think about planning. And we're going to start off with really where we started our company and where we decided, hey, we need to have a different model. And that's integration of tax planning. Unfortunately, the financial structure, the models, the companies that exist today, where we started at Morgan Stanley, a lot of times they don't allow you to get into this type of work. And it makes sense. It's risky for the organization, but really is kind of the backbone of one of the main powers of a multifamily office. And so as we started to think about the importance of tax planning to our clients, some of these strategies that we're going to talk about certainly, really shine. So kind of digging in there, Justin, a little bit, as you think about, especially as the CIO, as the person that's really guiding our planning process, as you think about the integration of tax into a high net worth family situation, what are some of the big things that you would say come to mind immediately?
Well, tax being one of the most important aspects of an investment portfolio and a broader just wealth strategy overall. That's first and foremost, not a direct answer to your question, but it is incredibly powerful if you can be just tax aware, minimize taxes. We like to say you have one net worth, you have one effective tax rate. If you're not thinking about all of those things or both of those together and optimizing them, you are leaving money on the table, quite simply. And, from an investment standpoint, the few things that immediately come to mind are just keeping taxes within a portfolio, or tax drag is a way to think about it, within a portfolio as low as possible, just leaves more money in your investments, in your accounts, to continue to compound over time, right? There's that famous saying, compound interest is one of the most powerful forces in the universe. And, it's a tongue-in-cheek saying, but it's also incredibly true, right? If you can minimize or maximize, add to your rate of return incrementally, very, very small little percentage points, we call them basis points in our industry, and if you just do a simple math problem, you say, okay, 1.1% versus 1.25%, and look at the difference over a 20, 30-year period of time. It's incredible. And it's really easy to find little savings like that from a tax planning perspective when it comes to investments. Some specifics around that, we talk about this a lot, tax loss harvesting. When markets give you the opportunity, it's not necessarily a fun market environment to be in. We've seen it a lot this year where markets have declined, not insubstantially. It's been a more challenging year for sure, but hey, we can't predict those things, but we can take advantage through things like tax loss harvesting when opportunities arise. Taxes are one component, but I want to put this broad expense or cost term or umbrella around this conversation as well, where really at the end of the day, what we're talking about is minimizing costs or minimizing expenses or frictional forces within a total financial structure. Investments are a big portion of that. That's what the question was, and that's what I focus on quite a bit. But we are very much a total financial structure, total net worth driven firm, and optimizing everything that goes into that equation. And so taxes are one of the biggest costs that are incurred within a total financial structure, but there are other costs within: investment costs, trading costs, transaction costs, et cetera, where you need to think about all of these together to minimize them for the exact same benefit, right? You can only consume, continue to invest, and give, ideally at the end of the day, your net after-tax returns. And so really maximizing them is a key driver to long-term growth.
I think that's a great point to hit on. And I think also giving some context on who ultimately should be responsible in these situations for making sure these things happen, and why maybe some people don't pay enough attention to them. So tax loss harvesting, great example. We have talked about it a lot, but if you think intuitively about this, and this episode is about advising the ultra high net worth, most of America, this isn't applicable to. Most people save their money in retirement plans. So either their company 401k or an IRA. These are all tax deferred vehicles. Tax loss harvesting has no benefit. Right. So you don't actually have to go through this process. So many advisors, maybe they put it on an annual schedule. Great question to ask your advisor. When do you guys take a look at tax loss harvesting? The unfortunate answer is most advisors take a look at, once a year, usually in the fourth quarter. At the end of the year, they're going to look at your portfolio. Are there any losses that we can harvest here? You want a more robust strategy, no matter who you are. It's just that oftentimes advisors aren't as, paying attention, aren't in tune with this because it's just not as applicable to all of their clients. So that's one big reason. And this is going on the advisor. So many people want to separate tax and investment and planning because they think checks and balances, etc. We've heard this before. We've talked about it before. I think it's unfortunate because it's a misleading argument, really, by the big wirehouses that can't do the tax planning. But at the end of the day, these CPAs, they're not in your portfolio every day. They're not looking at your situation every day. They're gathering their information at a point in time and doing what they're great at, and that's actually filing the returns, the compliance, looking for those write-offs that most people probably think about when they're thinking about tax mitigation, etc. But what often gets missed across the board here without this integration is even beyond the implementation in the portfolio, right? It's actually the little things you do, like evaluating Roth conversions, evaluating whether we should be maximizing HSA, health savings accounts. Do we contribute to the pre and the post tax of our 401ks if we have those? Really thinking through what are all the different account structures that we can take part in. And unfortunately, a lot of times, these are things that the CPA misses, again, because they're looking at your situation at 1 or maybe 2 points in time during the year. And then your advisory firm, if they're not focused on tax planning, probably miss as well.
Yeah, totally. Well, and taking that concept that you were introducing even a level deeper, right? We can start to think about, well, once we've made the decision to make a contribution or maximize a 401k or a Roth 401k or done a Roth conversion or a backdoor Roth contribution, right? All these planning tools, each one of these are unique, and there's a benefit to it. But then how do we take that money and invest it? Well, there's a tax maximization strategy around that. It's called asset location. Each one of those accounts has a different tax nature. And if you go back to this idea of you have one net worth, one effective tax rate, each one of those buckets should roll up to a broader portfolio or a singular strategy, not invested in each and every way the same, right? So often you see a Roth account invested the exact same way as a taxable account or whatever the case may be, where the strategy is just the exact same across the board. And it's just silly. You're not being efficient. You're not optimizing your net worth and your tax rate, where really what at the end of the day makes sense, looking at things as one and then putting the tax efficient assets in taxable accounts are going to have a lower tax drag. Again, these are the things just to minimize your overall frictional cost of the portfolio to get these basis points. And in some cases, it's actually much more than basis points or tenths of a percent. You can start to get close to a single percentage point, and that's substantial savings and substantial rate of return to add again to your portfolio, so it continues to compound over the long term.
Yeah, and I think it's really interesting. Another quick question I think you can ask of your situation is, am I familiar with what a backdoor Roth IRA is, right? That's something we see missed all the time, more commonly or maybe less commonly called, but a non-deductible IRA. If you're hearing those terms with your advisor, that's probably a pretty good sign. But those are things that you should be just chipping away and continuing to take advantage of. We've mentioned these Roth conversions. So again, most people, this happened with my father before we got in the business, but a very fortunate, successful career. When he got done, had a rather sizable IRA that he was going to have to live the rest of his life on. But what he totally missed throughout that entire period of time, or even the period of time when he stopped working, was a lower tax bracket where he could have been converting that IRA to Roth IRA, giving us more flexibility now to minimize his tax rate, essentially. And at some point, he's going to hit an age where the government actually makes him now take these required minimum distributions, and we lose all control of tax rate at that time. So this isn't something that you just pay attention to later in life, right? This is something that if you start early, and it's never too late to get started, but if you start early, it can just have dramatic results over time. The other big thing I always think about in this, and sad thing that we always see, is, the charitable side. People have such great intentions, especially people of means, and they want to help other people. And oftentimes we just see people giving cash, and it just eats at me. It kind of kills me, actually, because it's just money. It's wasted impact at the end of the day. And if that's really important to you, there are really easy ways to go about this. And one of the biggest ones is gifting appreciated securities or assets. It doesn't have to be a stock. It could be a piece of real estate, etc. But what you're doing is, by gifting that asset to a charitable organization, you never have to pay the tax on the gain of that contribution, which is absolutely massive. The entity that you're giving it to doesn't have to either, because they're a nonprofit organization. So the impact that you're picking up there is pretty dramatic. And, there are different ways to even make sure that if it's a small charity, maybe they can't accept those types of assets. There are other tools, right, that we can use for that.
Yeah, there are other tools. And if there is substantial charitable intent and substantial wealth, donor advised fund is a great, efficient platform. But even if there's really, really intense charitable intent, a foundation might make sense. Sometimes it doesn't. Actually, most of the time, a donor advised fund accomplishes the vast majority of what you might want to do, but a foundation starts to make a lot of sense, where you can handle assets that are a little bit more esoteric, a little bit more illiquid, and the foundation itself is the vehicle that deals with the complexity, and then you pass through the donation to the smaller charity that you're interested in.
And I think at the end of the day, we'll kind of wrap up this section. We threw a bunch at you here, ideas, and I know we probably talked a little faster because we get excited around this stuff. But at the end of the day, the big message is you want your team to be really focused on helping you to minimize taxes. And there are a lot of ways to go about it. There's a lot of flexibility, a lot of opportunity when you're in that kind of ultra high net worth, or even in a high net worth type position. So you want to be focused on those strategies. And then it really all bleeds over right into that investment portfolio. And we're going to kick off probably in our next podcast to how to go about investing that portfolio based upon your situation, based on you being a high net worth individual. How do we use asset location? What are the different types of assets that we put towards your priorities, your financial structure? Why is that so important, et cetera?
And also a thread that goes through all this as well is utilizing intergenerational transfer of wealth. It applies to everything we've really talked about, and especially the investment side, and we'll get into that more.
Cool. So we're going to close out for today. As usual, give me a text, 602-704-5574. We love hearing from you guys. Getting these comments. Hopefully we're addressing the questions that are being asked that we're getting on there. So shoot me a text. Would love to connect with you. And until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.